Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. I hope you all have enjoyed our daily market commentary on our website, podcast, and YouTube channel throughout the week, covering everything from the market moves and what happened post-Fed meeting. On this weekend show, we're going to be spending the first half of the show looking more broadly at the market, some of the economic data, and diving into the bond market and commodities. In the back half of the show, we're going to spend our time in the energy sector, oil and natural gas, and some of the opportunities within that sector and that area. To kick off the show, we are chatting with Peter Boockvar, Chief Investment Officer at Bleakley Financial Group, also editor of the Boock Report, which you can find on Substack, which I will link to in the show notes. Now, Peter, let's talk about the market here. The markets continue to, in a way, grind higher. They've lost some of that upward momentum, but that being said, S&P and NASDAQ recently did hit some all-time highs. The Dow has broadly lagged, and the small caps, the Russell, is still, way behind a lot of these markets. But again, there doesn't seem to be a ton of fear in the markets. But that being said, that momentum has been lost to the upside. What have you noticed in terms of market internals, Peter?
It's been very much an either-or market. It's either NVIDIA and Apple and Google and Microsoft and anything touching AI, or it's everything else. Because when those stocks rally, seemingly other things sell off. And when those stocks sell off, everything else rallies. I think in the aggregate, those big names continue to drive the headline indices to well outperform everything else. If you even take the S&P market weight return, you're talking low double digits. If you look at the equal weight return, it's under 4%. You see the Russell 2000 also lagging dramatically here over the past, call it, month plus. And I always find these divergences interesting because if those big cap names are going to have sustainable success selling AI products, they need the rest of the stock market, the companies outside of those big names, to buy those products. So to be selling the buyers of those products at the same time you're buying the producers of them, I find quite interesting. And just the market cap increases are just astonishing. I read some stats somebody had on Twitter that over a 30-plus day time frame, NVIDIA added $1 trillion of market cap. And over a 60-year time frame, Berkshire Hathaway is only nearing $1 trillion. So a lot of this is certainly multiple expansion momentum because the market wants to pay up for where they can find growth relative to more sluggish parts of the market. But the market cap increases are just eye-popping.
Yeah, Peter, you said it. It's really been stunning to watch the rise of NVIDIA and just how quickly it's added in trillions to market cap. What has taken, like you say, other companies like Berkshire Hathaway decades to do the same thing. And there is a big focus on AI right now from investors. But you had made a point to us off mic and also in your Substack articles that when you sit in on a lot of company conference calls and earnings reports and just their guidance, AI comes up in the discussion. And just because it's a hot topic for investors doesn't mean it's really helping the bottom line of a lot of companies. I'd love you to expand on that point.
Because mostly it's been all on the capital spending side when it comes to developing these AI models. NVIDIA is obviously reaping the real benefits of it, but that's via the build out of the infrastructure to create these models. The actual purchasing of AI, whether it's Copilot from Microsoft or signing up for ChatGPT from OpenAI, it's much smaller relative to that spend. I do think, though, the last quarter, investors are beginning to ask the question of, okay, you guys are spending boatloads of money to build this out, but where is the return on investment going to be? And I think the other thing we realized after hearing from earnings from a bunch of software companies like Workday and Salesforce and CrowdStrike and so on, that the capital spending pie is not growing. It's just companies are just reallocating their spend away from one part of their IT spend to another, which I find somewhat interesting. And then you also have a slew of companies that are yet to aggressively spend until they see how this plays out. Because what we're seeing is Meta has its own AI platform that they're developing that's going to be open source, basically handing it out for free. Microsoft obviously has ChatGPT and Google has Gemini, and we have some others. And are these all going to be somewhat commoditized products that we're all going to have access to, and it ends up being just more of a tool rather than anything else? It costs those companies huge amounts of money to develop, but we get the benefit from all that spend with the, again, a return on investment calculation be very much uncertain.
So, Peter, from a big picture standpoint here, does AI, in your eyes, have a chance to change the world in the business sense, potentially in the way of lowering labor costs? Labor costs are a key component to a lot of inputs for companies, and in the way that, I guess, technology, computers made companies more efficient and more streamlined, could AI be going down that road?
Well, the first papers on AI were written in the 1950s. So AI in some form has been, and software and technology has been transforming the world since the history of time. So that's going to continue. This is just another sort of iteration of AI, this generative form of it. And yeah, it's going to be making life easier in terms of certain tasks, no doubt about it. But luckily, that's what technology, generally speaking, does. Just that we're able to, I can have this conversation with you over the phone, and it can be transformed onto a podcast, reaching thousands and thousands of people. You know, for years, when you call the cable company or the phone company, you're talking to a computer first. That's been going on for a long time. So, I mean, Google itself is, when it was created, search was a form of AI where it grabbed everything out there that it could find to help you and refine your search. So it maybe this is many leaps forward, but yeah, but that's what technology does, and that's the beauty of it.
Well, it's really created a bifurcated market, as you mentioned at the onset, where it seems like there's the haves and the have-nots, with so many investors piled into such a very narrow bandwidth of mega cap tech leadership. Do you see any opportunities in the small caps or in the rest of the S&P 497, 493 that are not included in those top 7? Do you think that we'll see the market breadth improve and more investors take some gains in the space and filter it into other areas of the market?
So you basically asked the most important question, because yes, firstly, there are a tremendous amount of opportunities that I find out there outside of those names. There are many value stocks that we own, many stocks even in the commodity space that even after having a rally still remain very attractive. And to your second point, the question is the market going to broaden out, or are these stocks going to catch up? Will at some point value close that performance gap with growth? Or my fear is, on the other hand, what if these big stocks crap out? What happens if NVIDIA misses earnings next quarter, or in 3 quarters, or in 4 quarters, because order rate's low, or inventory is building up and they had to cut prices? What happens if some of these companies disappoint? Because there's no room for error. The valuations that they're trading at, I mean, Apple is back to 31 times earnings. There's no valuation support there. It's running on AI hype. So if those stocks took a breather, do people then rotate into other things? Like I mentioned earlier on the either or market. If you go back to 2000, 2001, we did see that. We did see tech crack, but investors were able to find other things to buy, particularly in the value space. Now, unfortunately, the latter part of 2001 into 2002, everything collapsed and gave it up. But there was a period of value stock outperformance. I'm hoping that repeats itself because, like I said, there are many opportunities out there in the value space. But it's clear that investors believe that the only place that they're going to find attractive growth is in these big tech stocks or certain parts of the semiconductor space, for example. But you know, there are plenty of other companies that use technology that are customers of these companies that are going to benefit from these technological advancements, particularly AI.
What about the shift to more defensive assets or investments, like moving more into the bond market? We do generally have higher rates. However, they are off of some of their highs from late last year and even just a couple months ago. But as much as people, I guess, can get 5% on a safe money market investment, they're still chasing the markets. Does that change?
That's very interesting point because yes, that risk-free rate is much higher than it's been. And your hurdle rate is 5%-ish. And obviously based on certain stocks in the market, they're very comfortable and confident that they can clear that. But for the rest of the market, I mean, people are thinking, why am I going to take risk in the small cap stocks, particularly one that is more sensitive to changes in interest rates? I mean, there is a fundamental factor here going on, and that a lot of certain set of companies, smaller companies, are more sensitive to the inflation that we've seen and wage costs that are higher and the cost of capital that's higher, and that has impacted business decisions and decisions to expand. So there is a fundamental factor creating this underperformance in small mid relative to the very big. But you just wonder how sustainable that is.
Well, when you think about interest rates, Peter, and you think about how the bond market auctions have been going, they haven't really been going that hot. They've been kind of weak, depending on which one you were looking at. But for a while, you just made a note in your morning missive that the 10-year actually was pretty well bid this time. And I wonder, does this play in at all to what the Fed is doing with their quantitative tightening, where they're kind of throttling it back, just like they tapered their bond buying a couple of years ago? Now they're tapering down the reduction of their balance sheet. I think they were at 90 billion a month and they were at 60 billion. Now they're down to 25 billion. At one point that will end, which means they'll actually be buyers in the market again. Could that be part of it? Or what's your take on the bond market and how the Fed's QT plays into that?
Well, the QT was reduced from 90 to 55 because it was really, the mortgage part did not change. The Treasury part went from 60 to 25. So, but yes, that easily could have been a factor. The one thing that I touched upon is you wish you can survey the buyers for why they did what they did. What was the motive of the aggressive buying, particularly the day before a Fed meeting, particularly the day before an important inflation number? Is what were you thinking? Was it because the Fed now is not really essentially selling as much as they were? Are you worried about economic growth? Are you worried about the continued rise in the unemployment rate? Are you seeing that other central banks are cutting interest rates and maybe you think the Fed is going to follow? You wonder whether all of these were a factor. Now, we have this, of course, comes after the 3-year, which was not good. And maybe the 30-year will not be good either. And this 10-year could have been an outlier. But you wonder why we saw such aggressive buying. And to quantify, the bid to cover ratio for this Treasury auction was the best since February 2022. So there definitely was an underlying bid there. And you always have to wonder why, particularly when yields continue to fall in response to that.
Where do you see a sweet spot for yields? We've heard of this higher for longer narrative, which it seems like the market's even starting to come around to. But interest rates, look, again, they're off of their highs, but they're off of their lows from late last year. Is this going to be more of a stable rate environment in your eyes, more of a sideways move?
It could be for a period of time, but that's the thing about higher for longer is sideways still is in a way a continuous form of tightening because every day there's some loan that's maturing. And you can only imagine all those companies, all those real estate people that have just been praying for lower interest rates. All interest rates need to do is stay where they are, and there's continued pain for anybody that has debt coming due. That maturity wall is still out there, whether it's in corporates or commercial real estate or wherever, or even somebody's adjustable rate mortgage in the U.S. or anywhere in Canada, in Australia, in the UK. Anybody who has a mortgage that is resetting to this that was priced before this jump in interest rates, they're getting impacted. So the pain can still occur with interest rates just staying where they are. Now, on the flip side, there are people that are benefiting from higher interest rates. Those that have saved money, those that are benefiting from 5% interest income. They're loving this. Baby boomers are loving this because after 15 years in the desert searching for a positive interest rating on their savings, they finally have it. So there's certainly pluses and minuses that we've seen from a higher interest rate environment, just as they were when rates were at zero. When rates were at zero, the borrowers loved it. The savers hated it.
Yeah, it's an interesting point, Peter, because for the first time ever, savers can finally get some yield. But like you mentioned earlier, the small businesses and people in real estate are dreading, and even in commercial real estate, are dreading those loans as they roll over, as are a lot of municipalities and governments as their loans roll over. So it's going to be interesting to see how this higher for longer or even just stable for longer plays out as more loans roll over. Another sector that's definitely affected by interest rates and by the moves in currencies also comes down to the commodities. And we've seen the commodities in general getting a nice bid the last couple months. From February to May, we saw everything from gold and silver and copper to nat gas and aluminum and zinc and nickel all clawing their way back higher again. Over the last couple weeks, though, the commodities have generally rolled over. Do you read into this anything as far as the economy? Is this due to the Fed cutting cycle, or is there something abroad on the global picture changing up the dynamics here for the commodities sector?
I think it's more of a rest. I think certainly one thing that has been driving the higher commodity prices have been worries about supply. I mean, you look at cocoa, that was clearly a supply-driven price spike. You look at coffee, it was a supply-driven price spike. You look at copper, I can argue the same thing. It wasn't, I mean, there's definite demand drivers out there, but it wasn't like they came out of nowhere to result in that spike. But yes, oil prices have fallen, but natural gas prices are quietly at the highest level of the year, just over the past couple of days, just as we get into the summer season and people are turning on their air conditioners. So I think in the aggregate, there's been a nice run in commodity prices. And to me, they're more just taking a breather. You look at the CRB food index. I mentioned a few ag prices, but it's just off the highest level since last October. It wasn't too long. Maybe it was just within the last, call it, I'm just looking at a chart, it was just a few weeks ago where the CRB raw industrials index hit a multi-year high. It's since pulled back, but it's still well off its lows. It's still well off its highs, but well off its lows. I think commodities are in a bull market again, and these pullbacks should be used as buying opportunities.
Peter, how much do we need to pay attention to China through all of this? I know that we've touched on it before, but Chinese data and their stockpiling of copper seem to have a role in the copper market. And then the recent news of them, the Chinese central bank, not buying gold through the month of May. How much of an impact? How much do we need to pay attention to China?
Well, they're the elephant in the room when it comes to a lot of these things. They're so big with what they need to buy and what they want to stockpile. So we have no choice but to pay attention. I mean, when you think about how astute China was over the past year and a half to be buying as much gold as they did, while Western investors, via what we've seen with the liquidation in ETFs, they've been big sellers, thinking that the rise in interest rates was going to be negative for owning gold. China's still going to be a major player. Now, you look at copper, they're obviously buying less copper when it comes to the residential real estate development because they're not building as many apartments, but China still needs a boatload of copper to build out their electrical grid. India is now the big buyer when it comes to a lot of these industrial commodities. They're the massive buyer of copper. They're spending $1 trillion in infrastructure over the last couple of years and with plans to spend another $1 trillion. So they're a big player. That's to think about when you think about, I think it's very easy for people when they look at the commodity space to just say, okay, where's U.S. and European growth and what's China going to do? Yeah, okay, that's fine. Those are big economies, but you still have to look at the rest of the industrial world, the rest of the emerging market world. And I mentioned India, but you also have Indonesia. You have South America. You have other parts of Asia. Everyone trying to modernize. Growing middle classes everywhere that want to eat proteins instead of rice and beans. They need more. They need more protein. You need more crops as feedstock. You need more wealth to buy more cars. You need more metals. I mean, I think there's an underappreciation. And yes, China is a major player. They will continue to be. We also have to expand what we look at when looking at the demand drivers for these things.
Well, Peter, just tugging on that string, when you think about the demand drivers, in addition to the whole developing world needing electrification and needing more proteins and needing more vehicles and gadgets, just like in the West, there's also the whole narrative that AI has now infected the commodity sector. When you think about the power generation that's going to be needed, they keep talking about these AI data centers, not to mention all the EV stations that need to be built and the crypto mining. So the demands on the power grids are going to be huge in every country. And that is doing things like spiking copper, as far as the wiring and transmission of electricity. Nat gas has got a boost, and they're covering that. Silver's got a boost because they're mentioning all the solar panels and solar farms that'll be needed. Uranium and nuclear power back on the menu. Do you think that the energy story is another thing that's possibly responsible for some of the recent rise in the commodities that relate to energy?
There's no question, because when you rewind the clock a year before we were talking about AI, really the current version of it, I guess we started talking about AI in late 2022. So rewind before that, none of these conversations were taking place. And all the things that you mentioned are long lead time type investments. The incoming CEO of Freeport-McMoRan, the big copper producer, was on CNBC saying that developing a new mine, you're talking about 7 to 15 years of finding it, developing it, bringing it to production. This newfound demand for everything that you mentioned, particularly power from utilities, this wasn't in anybody's game plan and budgeting just a year and a half ago. So to all of a sudden see the demand side, the supply side, it's impossible for it to timely catch up. It takes time. It takes many years to prepare for this flood of demand that wasn't anticipated. Hence the rise in all these different things that I think will continue, notwithstanding these pullbacks.
So, Peter, circling around just to the broad markets, investor sentiment, mentality, and where some of these markets stand. Again, a number of markets have done very well over the recent past. Have you seen this in history before, where we have central banks that are now possibly starting to slowly cut rates? Again, we are recording this before the Fed meeting, but we saw 2 rate cuts last week out of the ECB and the Bank of Canada. Markets are up at close to, if not all-time highs. Commodities have gone through a good run. Any times in history we can relate this to?
No, usually central banks are cutting rates because the economy is in a recession and they're all scrambling to save growth. This is definitely unusual. And at least right now, the cutting that we're getting, at least if you listen to ECB members and even Bank of Canada, which is cutting, and we know the SWIFT have, they're treating this as more of a tweak rather than the beginning of a progression of cuts, because they can't rationalize a progression of cuts. Yes, inflation is fluid. They're happy about that. They're cheering that. They think it's going to stay down, which remains to be seen. But I understand they're trying to take the edge off that sharp and dramatic rise in interest rates in a very short period of time. So I think a tweak is okay. I think even if the Fed threw in a tweak this year, that would be okay. But that's a much different scenario than what we've seen in the past, where the first rate cut was opening the floodgates of many in order to save an economy. This time it's much more complicated, and central banks still have to deal with the risk of inflation flaring up again. What happens if we're right on commodities and they continue to head higher, and this pullback in oil reverses and goes back to $80 or $90, and natural gas prices continue to rise, and inflation flares up again? Then what are these central banks going to do? They're certainly not cutting anymore. Now, we'll have to see whether they reverse and hike again. They can potentially be caught flat-footed. I think one of the lessons learned from the 1970s was not only do you want to see a decline in inflation, you want to see a sustainable decline in inflation, because acting prematurely without seeing the sustainability of it, then you create the situation where it flares back up again. And so it's almost like catching this inflation nice that some of these central banks that are cutting, that's what they're doing, and hoping that they don't get cut. I think that's right now a dangerous game. Again, I'll give them their tweak. The Fed maybe will give a tweak, take the edge off a little bit, but we're far from going back to the days of zero interest rate.
Yeah, we really do seem to be. Always interesting comments here, Peter. Thank you so much for taking time with us. Again, I recommend everybody checking out Peter's Substack, The Boock Report, which a link will be posted in the show notes. Always valuable to have you on the show, Peter, and I really enjoy reading over all the notes you send out to all your subscribers. So keep up the good work. We'll probably chat again sometime next month. Peter, I hope you have a great rest of your weekend.
Thank you, guys. Always a pleasure chatting.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, we are now shifting our focus to the energy sectors. We are chatting with Dan Steffens, president of the Energy Prospectus Group. We're going to cover the move in natural gas up to $3. Oil still stuck in a range, and a couple stocks, and unsurprisingly in the natural gas sector, that Dan likes at these current prices and thinks that there is some upside here. So, Dan, let's start off with natural gas. Boy, oh boy, it was really stuck kind of in the doldrums there for a while, as it just couldn't seem to even get above $2. However, we have seen quite the rise through May and now even into June as we're back above $3. This has been a strong move. Again, over a 50% move just in around a month and a half. Dan, what's your outlook for natural gas? Is this just the start of a much longer sustainable move higher?
Yeah, well, at first when I saw this, I mean, natural gas prices increased more than 50% since the end of April. And when I saw that continuation just day after day in May, and then here we are, we're over $3 at the beginning of June already. And I'm thinking, oh, is this getting ahead of itself? This is the short run for cover. People getting too excited. But the weather forecast is the near term in the U.S. It's supposed to be hotter than normal start to the summer. We got our air conditioners running full blast, that's for sure. They're already warning in Texas. I think there's 12 or 13 states that are warning their people that they're maxed out on electric power generation. So they could be having short-term blackouts, brownouts, or whatever you want to call it, but having to restrict. But then the big driver is really that there's 3 large LNG export facilities that are on target, that are on pace to come online before the end of the year. They're going to add over 6 BCF, 6 billion cubic feet per day of additional export capacity. So we're going to go from, 14? Yeah, at the end of 2023, our export capacity was 14.5 BCF per day. And by the end of this year, we're supposed to be at 18.6. But then by the end of the first quarter of 2025, we'll be at 20.6. So going up more than 6.1 BCF per day over the next 9 months. And that will that's a big enough move. That's over 6% of the current U.S. gas production will be going to LNG export facilities. Now, we have a lot of gas. We're blessed with tremendous natural gas reserves in the United States. But the Permian Basin, even Appalachia, and now it seems that the Haynesville is also going to have pipeline capacity issues of being able to get their gas to market. So we need our politicians to get on board, which I'm not holding my breath that's going to happen.
Well, Dan, to that point, everybody makes the case that the U.S. has a lot of nat gas, and it does, but the capacity issue, the ability to get it to the pipelines, is really the choke point. So with these LNG terminals coming online, and we're also seeing a couple come online in Canada, how does that change the dynamics for natural gas on the global stage? Because right now it's very regional, but if we start exporting a lot more, and if Canada starts exporting a lot more to Europe where it's a lot higher, or Asia where it's a lot higher, does that balance the pricing out and lift the pricing here domestically but lower it internationally? How do you see that playing out?
Well, I think when you look at the whole world, we're trying to electrify everything. You know, you got the EVs in Europe are still selling pretty good, I think. Over in Asia, they're still selling. So you're going to need more and more electric power generation. And then, of course, you got the AI movement that's going to have a massive demand for electricity coming online. So the global demand for natural gas and for electricity, and a lot of it to be produced by natural gas fired power plants, is out there. So it's going to be an infrastructure issue is what's going to happen. So then what will happen in the price, if there is delivery issues, then the LNG exporters will get into bidding wars for supply. They're all down here. Most of them are down here along the Gulf Coast. And then they're going to be building all these gas-fired power plants in the Northeast for the AI deals, and they need the gas supply too. So you're going to get just bidding wars between the utilities and the LNG exporters for that gas. So I'm telling you that looking next year, if we have a hot summer this year, we have all these LNG export facilities come online in the next 9 months. And then if we have a normal winter for a change, or anything close to a normal winter, I think you got a chance to see $5, $6, $7 gas next year. And that can happen. I mean, like we were talking about before we start recording this, was that you pull up a 5-year chart, even in the last 5 years, we've had natural gas spiked over $9 an MCF twice during that time period. So it can happen, and it happens kind of when you least expect it sometime. Some of the biggest price spikes in natural gas have occurred in the summer months.
Dan, you even mentioned politics in all of this. And do you think politics does get in the way when these LNG facilities are up and running? If it does cause more of a domestic price spike in terms of natural gas, because, well, individuals won't be happy about that and politicians want to get elected, could politics get in the way of extreme price spikes?
I think politics gets in the way of all progress. You can't build pipelines overnight. You can't, build these terminals overnight. And plus, they're extremely expensive. So, you got to do it. But you can't transport natural gas by truck or by ship. Well, ship now that they can do LNG. But it's not as easily transportable as oil is. So you do have to have pipelines taking it to the end users. And anyway, but if they need it to run their business and the people are wanting to buy it. But the gas prices today in Europe and Asia are like $10 an MCF. And actually, natural gas on the global market trades more on energy content. So it does typically trade in the 1/6 to 1/8 the price of oil. So if you got $80 oil, and let's say it's 1/8 of that, so that's why you're up there to the higher price at $10 is normally the price where it should be. But we don't have that because we have a surplus in North America. But with this increasing access to the global market price, will have a bigger and bigger impact on U.S. gas prices.
Well, Dan, just translating this over into the gassers, into the companies or oil companies that have a nice exposure to natural gas and natural gas liquid, you made the point that you really like them to have the nice mix of not just the dry gas, but the liquids. Are there any names that stand out to you, or are some of these companies going to start hedging when these higher prices show up? How are you looking at the gassers?
Well, the strip now on gas is the other way. It's higher out when you go. So they could be locking in now. In fact, I interviewed a CEO of a small Canadian company yesterday, and he said they were hedging some of their gas at $3.50 or something up in Canada. And he was real, excited to get that higher price than what they had last year. And some of them should do that. And they did. Yeah. So what you need to understand about any company you invest in, upstream company, is the production mix. So most of them produce a combination of oil, crude oil, and natural gas liquids, or NGL, and then dry gas, which is the gas that comes into your home to heat your home with. And then you need to look at their hedging programs, because most of the ones that do a lot of gas, they do have quite a bit of their gas hedged. So if you're looking for the ones that can get the most bang, if you're really bullish on natural gas, you think it's going to go to $5 next year, average price or something, then go look at the ones that don't have any of their gas hedged. And a big one that I know of is EOG. EOG doesn't hardly have any of their gas hedged because they don't have to. And they do sell quite a bit of gas into the international market because they have gas supply coming out of Trinidad. So that's one to look at. One we'll talk about later on in the show is Ventive, which used to be called Encana. And it's a large cap with a lot of gas production, and they would really benefit from higher gas prices, that's for sure.
So, Dan, before we get into more of these stocks, as you mentioned, we'll talk about a couple of them. What about oil? Oil's still broadly stuck in its range. OPEC Plus recently had comments that pushed the price down temporarily, that they might lift some production limits. But does anyone even follow these limits anyway? So what's your outlook for oil still, again, stuck in this range?
Well, oil in April was at 87, so it's gone the opposite way of gas. So it was 87 in the first week or so of April, and then it dropped all the way to 73 after this OPEC announcement on June the 2nd. And that big dip, which has already bounced back $5, I'm looking at the chart now, and it's almost back to 79. So it bounced back. That was a gross overreaction by the what I call the paper traders. It's 30 times more oil trades on the derivatives market, or the NYMEX strip, than there is physical oil. And a lot of these hedge funds have a lot of long positions or short positions or whatever, whichever way they think it's going to go. And there was really just a mention by OPEC that they might, not that they will, but that they might start lowering or raising some of the quotas, allowing more oil to be produced. But it wasn't even that much. But the fact that they mentioned they might start backing off on their quota system But then they go, and then when the price dropped just a couple of days later, OPEC comes out with a statement basically saying, we just said we might, not that we were, and we will only do it if the demand is there. They're not going to do anything that if they believe it's going to really bring down the price of oil. And they're happy with, if oil, Brent is selling for in the 80s, they're good with that. They don't want oil really to spike to 100 or 120 because they know it'll kill the golden goose. They just want a stable, a fair price, and their economies must have steady oil revenues.
Well, Dan, just to that point, do you think where prices are now, let's say in the high 70s to low 80s, is that fair price, or is there any potential that we could see a spike to triple-digit oil? Because there's been some people prognosticating on financial media that they think it could surprise people. Have the markets gone to sleep and gotten lulled into a false sense of security that we're going to stay in this range? Is there a potential for a price pop?
I think the biggest potential is if the Fed does start doing interest rate cuts, meaning that they're going to support the economy to avert any kind of a recession, I think that would do it. That'll push oil into the 80s again. But oil prices are one of the biggest reasons we have inflation. So I think this recent comeback this week is because there's more talk about the Fed maybe in September, October, raising the interest rate. That could do it. I've adjusted my price deck that I'm using to evaluate companies. I came down from $80 in the second quarter down to 78, and now I'm using 78 in the second quarter, 80 in the third quarter, and 82.50 in the fourth quarter. I still think we are looking at, if we avoid a global recession, I think we're looking at prices in the low 80s at least. And then I'm using $80 for the 2025 for oil and $3.50 in 2025. So, and I do think my gas price could end up being way too low for next year.
Dan, you made an interesting comment to us off mic too about the relationship between oil and gold. We talk a lot about gold on this show, the spread between the prices. Take us through some of the historic data here, please.
Well, historically, the price of oil is 1/20th the price of gold. So if you've got gold at 2,400, so 1/20th of that would be $120 oil. So obviously we're way below that. Now we have some members in Energy Perspectives Group that they are very keen on this issue, and they believe that gold's going to come down or oil's going to go up, and all of them don't believe oil's going to, or that gold's going to come down. So they think that will eventually pull up the price of oil. Gold is a hedge against inflation, and oil is also a hedge against inflation. So they go, but it's on the global market. And right now, the global market seems to be adequately supplied. I also saw today, I think IEA actually raised their demand forecast a little bit. And that may have been because the oil price jumped on Wednesday, almost $1 again. It was down a little bit this morning because of a storage report by EIA, but then it immediately bounced back.
Well, Dan, with this information in hand, as far as basically you're expecting higher oil prices in the third and fourth quarter, maybe in the low 80s, and you're expecting natural gas prices to stay high, possibly getting into the 350 to higher zone next year. With that in mind, you mentioned a couple of companies to us that you wanted to flag as potential opportunities for investors, and one of them is really a mineral royalty company, and that's Blackstone Minerals, trading the ticker BSM. It's interesting because we talk a lot about gold and silver royalty companies, but these companies are doing the exact same thing with mineral rights, and a lot of the exposure with Blackstone is actually to natural gas and natural gas liquid. So I'd love you to unpack, with this kind of dynamic in the underlying energy prices, how does a mineral royalty company like Blackstone fare?
What I like about Blackstone is they are super conservative. They basically have no interest-bearing debt. I mean, they have some bank fees because of their credit line that finance expenses. But as far as paying actual interest expense on long-term debt, they don't have any. And it currently pays a dividend that equals $1.50 per unit per year. So the dividend yield is over 9% today. And that dividend is super secure because of their strong balance sheet. And they produce about 74% of their production is natural gas and natural gas liquids. Now today, and they've hedged a lot of it. I think 60 or 70% of their gas is hedged this year at over $3. So they have that locked in for the rest of this year and first part of next year. But then if the long-term price of gas, and they keep rolling their hedges forward. So if the price of gas starts going up, they'll be locking in that higher price with their hedging program for the second half of the year, next year and 2026. So I really like it for security, and it's a great way to play. If you believe natural gas has got upside, I think it's a safe way to play it because you get that real nice dividend. And it is a master limited partnership, so it does have some tax benefits. The actual net income of the partnership is what you pay your taxes on, not your distributions. And the distributions are higher than the net income that will be allocated to you. So there's a little bit of a tax break there. I would warn people that a lot of people want to put these high dividend companies into their IRA accounts. If you do, there are some special reporting requirements, and it can be a problem if you put a lot of money into them. So just understand the tax requirements, tax reporting requirements if you do that. But so they should be held in taxable accounts, so you get the benefit of it at the lower taxable income on your tax return. But it's a good one. My fair value estimate is $17.25. I think it's traded at about 16. So there's not a lot of, I don't see a lot of upside in the share price unless they raise their dividend. And I do think they might raise their dividend next year. So there's upside too on the share price. Tip Ranks, which is a service that I get, their price target is $18.50. So they see a little bit more upside there than I do.
Yeah, that dividend yield already close to 10%. That's pretty solid. And if you even think they might raise that, hey, that's worth noting. Some more of a safer play, I guess, in the natural gas sector. Let's also talk Ventive. You have whet our appetite for that one, traded OVV. This is a large natural gas producer. It's in your Elite 8. And in your Sweet 16 growth portfolio, I believe. So fits in both of those portfolios. Take us through where they stand in terms of some of their production metrics and where you think that growth is then going to come from.
Well, the share price closed at $48.60 on June the 11th. And my breakup value today, I believe, is $71 a share. This is a large cap company with 500,000 BOE per day of production. They do produce a lot of gas. About 45%, I believe, of their production is gas. Let's see. Okay, the actual percentage for this year is 47.5% natural gas, 36.5% crude oil, and 16% NGL. So let's see, 64% of their production is tied to natural gas prices. Natural gas and NGLs are usually driven by the natural gas price, but it looks really good. They've made a lot of progress this year, paid down some debt. The balance sheet's in much, much better shape. And what I like about it, this is a company you guys would be familiar with up in Canada called Encana. It changed their name to Ventive, and it moved to Denver, their headquarters, because now most of its operations are in the United States. But it also has a track record of under-promising and over-delivering on its production guidance, which I like. It makes me look good. They meet or exceed my production forecast almost every quarter. And it's just a good, solid company. I think it's got like 50% potential upside in the share price. And it also pays a dividend, not 9%. It pays a smaller dividend, but it pays a little dividend. And it's got a stock buyback program underway. So it's got a nice shareholder-friendly distribution of their free cash flow. So I like it. It checks all the boxes, why it's in my Elite 8.
Well, Dan, just one more on the nat gas companies in general. We've seen a nice pop, as we mentioned, almost a 50% pop in the price from 150 to 3. But it doesn't seem like a lot of the nat gas companies really responded that big. I mean, they've moved up a little bit, but they haven't made the same kind of move as the underlying commodity. Do you think that's because they've already priced in this move and they've got some hedge like that? Or do you think that the market is still not believing this move is sustainable? And do you think there's more upside in these gas companies or oil companies that have a nice nat gas component?
Yeah, and I really think the movement in the gas price is not really it's not like oil going to 100. It's not like it's just really getting back to a fair price. I mean, these companies were struggling to make money. When gas was below $2, they were struggling to show net income. Well, at $3, they're profitable, but they're not grossly profitable. But now every 10 cents more of gas price you get is just 90% of that is falling right to the bottom line. And they have low operating expenses. And that's what I like about some of these companies like Antero EQT. EQT is also in our Elite 8. It is the second largest gas producer in the United States, second only to Chesapeake. And I like Range Resources. I really like Range Resources, and they do pay a very nice dividend. That's a good one. So just look at the production mix of each company. And then also what's good about Antero, Range, and EQT, those are all producers in Appalachia. They're the ones that are producing Marcellus Shale and Utica Shale gas. There is some pipeline issues up there, but EQT especially has got a lot of firm transportation, a lot of pipeline capacity already tied up, guaranteed to them. And so they're going to be able to get their gas to market, and because they produce such a high volume, like 5 BCF a day. I mean, they produce 5 or 6% of the total U.S. production. That's how big this is. And they're going to do really well. And if gas does go to $4, man, then it's sky's the limit for that one.
Dan, do you see any money filtering down into these smaller, either natural gas plays, if natural gas continues to move higher, if there's maybe a certain price level around there, or even into some of the smaller oil companies?
Yeah, the thing is, and we were talking about this yesterday on our webinar, that, boy, the volatility, and really when you look at the oil price, it's stabilized a bit between 75 and 85. It's trading in a range. It seems to be okay there. And these companies are extremely profitable with an oil price of 75. They're very profitable. I mean, just look at the first quarter results. The first quarter results were based on oil average $77 a barrel in the first quarter. And I got it being higher than that for the entire rest of the year. And they all reported really good first quarter results. And the natural gas price in the first quarter was $2.10. So you can see they're going to get so much more revenue from their gas and their NGLs going forward that even if the oil price just doesn't do anything, they're going to report much higher revenues in the back half of the year. And they had weather-related issues too. A lot of them had production down a little bit for the winter weather in the first quarter. So they're going to show some production uptick and much better realized prices going forward. So yeah, but still, some of these Canadian juniors we've talked about in play, we've talked about Hemisphere. I interviewed the CEO of Journey Energy yesterday. That's a Canadian junior. And these stocks are trading for just over 2 times, 3 times cash flow. That's insane. I mean, several of these companies are trading below book value, which is just crazy. They're profitable. They're generating free cash flow. Hemisphere and InPlay pay really nice dividends. And I think they're both, one of them might be slightly above book value, but they're both got a lot of running room. They both look really good to me.
All right, Dan, we'll wrap it up here. Always great having you on the show. Thank you for diving into the energy sector. And it's either oil or natural gas that we're talking about, and rightfully so with the move that we've seen in natural gas. It's nat gas's turn. If it keeps moving higher, these stocks should start really moving, but this could be the opportunity for investors that were waiting for the price to start moving higher and then the stocks to follow. Maybe this is, as you outlined, the chance. Even in some of the bigger stocks, too, we always see the big stocks move first. Again, Dan is the president of the Energy Prospectus Group. That link will be shared in the show notes. Dan, thank you for joining us on this weekend show. Everyone, thanks for tuning in to the weekend show. Be sure to go back and visit our website, podcast, and YouTube channel, the KE Report, for all of our daily editorials and company updates. I hope you all have a great rest of your weekend.
For our upcoming appearance schedule, visit kereport.com. The Corlin Economics Report will be back in just a moment.